Welcome everyone to the webinar tonight on property investing for where we are right now. It is July 2025, so this is definitely valid for the rest of the year, even going into next year. So for those of you who may not know me, my name is Jeanine Sciacca, and I'm a senior consultant for 2020 Property Advisory and have been for 10 years now, actually. I realized that today. So just to get right into it. So 2020 Property Advisory is owned by Mike Anderson. I've known Mike for many, many years. I started off as a client of Mike. And just to give you a quick story, when I first emigrated to Australia from South Africa, I bought my first investment property from some other group, I won't mention their name, down in Geelong. And at the time, they said to me, this is the fastest growing suburb in Australia. And they showed me some numbers and I believed them. And I ended up buying a brand new house and land, 4-bedroom house off the plan near Geelong. Anyway, about 2 years later, I wanted to reinvest and buy another investment property. And I got hold of my broker and she said, what are you looking for? So when I told her, she said, oh, have you met Mike Anderson? And I said, no. She said, oh, Jeanine, you must meet Mike before you buy anything. You got to speak to Mike. So at the time, I did meet him. He came to my house, and as the first conversation, he just wanted to understand my situation well. And he said, what do you own? And I told him about the house in Geelong. And immediately Mike said, oh, if I was you, I'd sell that. It's probably going to go down in value. And I thought, property never goes down in value. That's, crazy. So I didn't pay any attention. Anyway, Mike showed me some properties, but 2020 Property Advisory does property research. So Mike had a lot of research about two particular areas. At the time, it was the Sydney market. It's no longer, but at the time it was one in Central Coast, one in southwest of Sydney near Bardia, Ingleburn Gardens Way. Anyway, I bought these two properties from Mike. They did very, very well. And when I was signing contracts with him, or every other year when I caught up with him, he kept saying to me, have you still got that house in Geelong? And I said, yes. He said, Jeanine, sell it. It's going to go down in value every time. And I thought, property doesn't go down in value. Anyway, years passed on, and I'd made really good money on my one particular house in the southwest of Sydney. And our strategy, which I'll show you in the presentation tonight, is to exit a market when it's peaked. Take the profit, pay all your capital gains tax and agent's commission, what we call the entry and exit costs, and get into the next growth market at the bottom and take the next growth, because you make a lot more money that way. So Mike suggested to me that I think about selling the one I bought from him. And then he said to me again, have you still got that property in Geelong? And I said, oh yeah, I've just left it. He goes, why don't you call an agent and see what it's worth? And honestly, it had gone down in value. And I just want to mention this because there was no research with that property choice. When the agent showed me it was the fastest growing suburb, I remember Mike at the time, when he came to see me the very first time at my house, he said, what do you mean the fastest growing suburb? It's not possible. I said, yes. He said, bring me the paperwork that they said this with. And they said it's the fastest growing suburb, and this is how they calculated growth. It was farms, and there was like one residential house, and then they cut up the farm and they made maybe, I don't know, 2 residential houses. Well, that's already 100%. As in one house becomes 2 or becomes 4 or becomes 6. But Mike said that's not growth. Growth is the price of your property goes up. And when I looked at it, it actually made a $35,000 loss. But luckily, Mike said to me, Jeanine, sell both the one that made the big profit in southwest of Sydney at the same time as the one in Geelong, so you can offset your capital gains tax. And I did that, and I got out of that property and I offset my loss. It was actually very good for the capital gains tax. I made very good money on Mike's. I made 180,000 then. And anyway, that's how I got to know him. And then when I started in corporate, my dream was to work for myself and do what I do today. I do personal development, and I wanted to be in property as well. And I got that wonderful opportunity to become a senior consultant for Mike. So Mike has been in this game for over 25 years. He's done finance when he began, so he knows all about that and structures. He was also a financial planner, so he's very, very knowledgeable. And he's done everything from property development, but most of the years been sales in both residential and industrial. And what 2020 Property Advisory does is we're a research-based property advisory business, and all our decisions are driven by property research. And this is really why, I guess, the areas we put clients into make above average returns. All right, just quickly, the team is really small. We're not one of these big property companies that put 400 people through a seminar. That's not us. We are a boutique business. We're small. We know all our clients. Before we started the recording tonight, I was greeting some people who are clients. We know each other. We'll always know each other. We will stay in touch with each other. So Pearlie works at the office. She also does some sales. And then there's Helen, who does the finance for us, and Ola, who does the marketing for us. All right, so just quickly, the business model that we use has to fit the client. So what we do is, the thing we do is we look for a mismatch in supply and demand, and we look at it on a national level. Then we take it down to the state level. Then we look at certain specific local government areas, the mismatch in supply and demand. We're looking for high demand and low supply, because when we've got that, prices go up. Once we're looking in the local area, we then look for reasons for the population to grow. The main reason is new employment. So an example of this would be a new hospital, okay? Or a new business center, or the rezoning of an area. Like in Sunshine Coast, there was the rezoning of Sippy Downs to a town center. That causes businesses to move into the area, demand for employment, demand then for property in around the area. Then we look at the demographics. This is so important. I cannot emphasize it enough. Who's moving in the area? Are they bustling families with 3 kids? Or are they singles and couples? Like in Sunshine Coast, there's a lot of singles and couples because there's a massive hospital, the biggest hospital in the Southern Hemisphere. They don't even have enough doctors and nurses and staff in the country, so they're contracting people to come from overseas. So when these people come from overseas, they're single. Some of them are couples, but most of the time they're single. So in that case, the demographics are completely different. You're talking about a 1 to 2 bedroom occupant versus 5 or 6 people in a bustling family. So you've got to know the demographics. So we do that. The next thing we look at is the infrastructure changes. This is the reason an area is going to grow slow, medium, or fast. Infrastructure. Infrastructure is things like hospitals, train lines, new shopping centers, new business centers, the head office of massive corporations who bring in, 3,000 to 6,000 people. We've had several of those. So those kind of infrastructure changes we know drive demand for the residential property around the area. Then, of course, once we've got all this information, we know what we're looking for. This is what we call entry options. So an entry option is, well, we could get in the market, we could enter the market in a 3-bedroom house or in a 2-bedroom townhouse. What is the entry option? Now, most people who sell property end there. We, on the other hand, and we're the only group that does property to help investors grow wealth, that looks at exit. We don't know anyone who talks about the exit point. What we mean by that is, before we buy the property, we ask ourselves, who would buy this property off us for a profit in the next 3 to 5 years? That we know we can exit in the short to medium term and make a profit. When I say short to medium term, guys, I'm not talking about get rich quick schemes here, because we don't do that, okay? I'm talking about 3 years minimum. Some clients do sell before that, but what we recommend is 3, 4 years, 5 years, 6 years, maybe even 7 years, but not, 20 years or 15 years, because then you could sell a person anything. If we know why a person would exit or buy the property off you for a higher price in the next 3 to 5 years, well, we've mitigated an enormous amount of risk. We know we're buying a good asset. So once we've got this information, we then get together with a client, and this is what we do. Let's start off at 1 o'clock. We meet the client, meeting 1. We want to understand their goals. Why do they want to invest? This is a really important question. And people say, I want to make money. That's not the why. That's like the goal. But what's the why? So the why is maybe you want to pay down the mortgage on your own home. Maybe you want to build wealth for retirement savings. Maybe you want to start to make some money so you have a large deposit if you ever want to buy your own home or put your kids to private school. What is the why? We define the client's capacity. Of course, we recommend that you see a broker to do that. It's more accurate. And we do give you some education because we share the research with you according to your situation and how we can help you. Then we go away after understanding what you want and we meet you for meeting number 2. At this meeting, we present an option to you. Maybe it's a townhouse, maybe it's a house and land package, whatever it may be. And then we discuss the strategy on what you're going to do to achieve your goals, whether it's in the next so many years or even longer term, whatever it is for you. Once you've seen some option and you like it, we recommend that we go and visit the property. So at the moment, we're looking at Queensland. We would get on a plane. I'd get on a plane with the client, meet them there. I'd hire a car and take them on a tour so we can actually show the client the infrastructure changes, the actual site where it's going to be developed, if it's not developed yet. If it is finished, we will take them to the site and let them walk through the actual finished dwelling, and to things that compete with it in the area. So when you leave there and get back on the plane, you are absolutely satisfied that you've got the best option in that suburb and you got it at a great price. And if anybody was going around trying to rent, they would definitely want yours and not the other development across the road or down the road, and the reasons why. So that's what we do, is that tour. Right, now you're going to go ahead. Let's say you go ahead. Well, we help guide you with the implementation and support you along the way. We don't do it, but of course we've got contacts in the industry. So if you need a broker or insurance or handover or depreciation certificate, whatever it may be, we can help. We get some good discounts as well. I'll give you an example with the depreciation schedule. We use BMT. They charge any client, anyone. You can walk in today and ask for one. It'll cost $715, I think, or $750. For our clients, it's about half that, about $330. Right, so we help you get everything going. And then this is the most important thing, step 4. We look after your portfolio for as long as you're our client. We'll review it. Today I wrote, several emails to clients who'd bought from me some years ago in Queensland, suggesting to that they consider selling and reinvesting, because we've peaked in certain suburbs in Queensland where we put clients in 2016, 17, even 18. So that's how we work. Now, when we talk about exit and selling, we do recommend an exit strategy. Now, I never grew up this way. When I grew up, my grandfather said, when you buy property, never sell it. And my dad said, if you buy property, never sell it. So I had this paradigm or programming, when you buy property, never sell it. And then I met Mike Anderson, and he said, you can keep it if you want, Jeanine. He said, but you don't make as much money as a person who buys and sells, reinvests, makes the money and sells, reinvests, makes the money and sells. And I didn't really listen, and I argued about it, particularly that Geelong property. That's what took so long to sell it, until Mike said one day, sit down, Jeanine, I want to show you actual numbers. So, for example, the property market does grow on average over the long term at about 8% year on year, but it doesn't grow in a straight line. It's got these short, sharp upswings in growth, followed by these long periods of stagnation. Now, what we do know is when one market cools off, another market takes off. And when that market cools, another market will take off. So this is theory. But if you can work with the property research and buy and sell according to the research like this, you can do very well financially in property and grow significant wealth. So that's theory. I'll show you in practice. These are actual clients, okay? In the year 2000 to 2003, the Sydney market shot off. If anyone's lived in Sydney for more than 25 years, you'll know 2000 to 2003, Sydney market grew. We told clients in 2003, sell your Sydney property. The research says we're going to Perth. So the reason the next entry is lower than that blue line over here is because we take into account we've paid capital gains tax, agent's commission, stamp duty and legal fees on the new property, and the prices were slightly cheaper. But you make back the entry and exit costs in 6 to 8 months. Oops, I'm just trying to find my mouse. There we go. And then you shoot off again, and it continues to grow. After a few years, we said, according to the research, let's sell Perth and go to Darwin. Again, exit and entry costs paid, prices slightly lower, A few months later, you've made that money back and you shoot off. Then we said, sell, we're going to Melbourne according to the research. I'm glad the diagram or the line looks like this because it's not perfect all the time. And then in 2012, we told all our clients, sell everything you have in your portfolio and let's reinvest the proceeds in Sydney, because we could see the research showed growth is coming, and look at that phenomenal growth. So the point here is, do you buy and sell, or do you do this long-term hold? Well, this client in blue said, I don't sell property. This was my old paradigm. I hold on to it forever and ever. So look, over time, he had a stagnant period from 2003 all the way through to basically 2011, 12. This is flat, and then it grew again. But the client that listened to the research and managed their portfolio landed up here 15 years later, and the other one landed up here 15 years later. And the difference between these two people is 880,000 better off. Now that's a lot of money, starting with one property back in 2000 that cost 50,000 or something. The point is, the buy and sell strategy is called financial velocity. You make your money, work faster. All right, so that's what we do. We manage our clients' portfolios. Hence today I emailed a dozen clients with the information saying we've reached the peak where we are. We recommend selling. We've got other options for you. So let's talk about the exit point. Sorry, let me just fix my camera here. 1 second. Okay, as for exit point, so these times right now where we are in 2025 actually allow us to implement this exit point of our strategy in certain suburbs that we put clients into approximately 2 to 7 years ago, and then roll into new areas. So right now we're facilitating the sale of some of our clients' investments, and they've made significant capital gains, allowing them to reduce debt on their own home or pay private school fees or put money into retirement funds, whatever they're doing as their goal. This also allows them to reinvest into new, more tax-effective growth assets, because after holding a property for 5 to 7 years, your tax deductions are way, way less. They're about half of where they started when you first got the new property. And then, of course, the clients made good money, they'll reinvest it, grow their portfolio, and continue to be happy clients. So I'm going to give you a quick market overview now. I'm not going to spend too much time, a lot of writing. I'll try and be brief. So just in brief, Australia's property market right now in 2025 is very resilient, even though we've had such high interest rates, even though for many people it's extremely unaffordable, it's very challenging for some people. And there's this consistent housing crisis, there's a housing shortage. We see very strong population growth, especially in Queensland, and this is driving incredible high demand for any dwelling in Queensland, in certain areas stronger than others, of course. However, supply constraints, these are things like slow construction, hurdles with all the regulations with the council, and these are exacerbating price growth. And also what we mean by rental market tightness means you cannot find a rental property. We've had some open homes, I kid you not, we've had 50 people go through an open home in one day. Some people putting 6 to 12 months rent on the table, saying I have to find a property to stay, I'll pay my rent a year up. Can you believe that? And that's because of this rental market tightness, because there's such a supply constraint. So there's a chronic shortage. If you haven't heard it before, I'm telling you, there's a chronic shortage of properties for people to live in Queensland. So for investors, it's a very healthy state, but it's not very nice for people trying to find a place to stay. Anyway, interest rate cuts, we've had a few and we expect maybe we'll get some more. And if this happens, well, we're going to stimulate more activity. And I just want you to know that there are regional variations in performance between one state, one region, one city and another. And these are significant, and I'll share some of those with you. So firstly, to understand the supply and demand gaps, this is what we do in our property research. We look for this. So as for demand, this is driven, as I said, by population growth, and generally population growth is driven by several factors, but one of the main one is new jobs. There's employment opportunities in some area, Another one is affordability. Queensland is way more affordable than Sydney or Melbourne. Anyone who's got the opportunity to move there would move there, have much more money to spend on just lifestyle because of affordability. Also, there's a trend to smaller households. Before the webinar was recorded, I was talking to two people here about the extreme demand in Sunshine Coast for one bedroom. Many people say to me when I have meetings with them and I put a one bedroom in front of them in Sunshine Coast, they say, why would I buy a one bedroom? I'll say, well, if you understand the market, if you understand the demand, if you understand the major hospital, the biggest in the Southern Hemisphere, and how many singles and couples there are, the demand for one bedrooms is through the roof, and there are hardly any. So I have to say one of our best performing options we've put clients into over the years has been those in Sunshine Coast that are one bedroom and two bedroom. So a trend to smaller households, yes, because KPMG did a research study several years ago showing how many 4-bedroom houses have got empty bedrooms, at least one, sometimes two. So why have those extra bedrooms if they don't get used? Downsize. As for supply, I said there's a chronic shortage. Housing supply is critically low. If you look at this, there were only 163.7 thousand dwelling approvals in 2024, but the National Cabinet's target is 240 new homes a year, so they're way behind. This is just 1 year I'm talking about. It's been like this year after year, and the gap is widening between this shortage of housing and where they are building new homes. It's just getting wider, not getting better, it's getting worse. So the key takeout is this imbalance is obviously one of the reasons for pushing price growth up, and this major pressure that there's nothing to rent. People can't find a rental property easily. It's really difficult. So savvy investors who enter the market now or early are very well positioned to actually benefit from these capital gains, because the earlier you get into a market, the more money you make, right? In a rising market. And also rising rental yields. The rents have also grown very healthy and nicely. So why do we have this gap? Why is there such a gap between supply and demand? It's because they can't build fast enough. Construction's got major challenges. The cost of construction keeps going up. Labor shortages are really a big issue. To find tradespeople, there just are not enough tradespeople. Lengthy planning processes. The council often has many delays. Getting land registered is slower than it should be. As for regulatory hurdles, again, zoning restrictions, slow land releases, all of these things affect supply. We've also got less builders than we had. Many of them went insolvent. A lot of them went insolvent during COVID. None of ours, I have to say, none of ours did. And that obviously affects supply if you've got less people to build. So the key takeout is it means that fewer new properties on the market, driving demand and driving prices up. So again, better to act now and secure the right asset before the scarcity pushes values up even further. And I say this, even if waiting periods are a bit longer, I don't have any problem with waiting periods. And I want you to think, unless you, okay, if you're not a seasoned investor and have done house and land packages in the past or bought properties off the plan, you might not understand waiting periods. You might think, oh, buy an investment property, I must have it today and it must be rented tomorrow. Let me tell you, I've been an investor for over 25 years, and even my very, very, very first investment property of my life was a townhouse off the plan. And it took, I don't know, back then in South Africa, I don't know, maybe 9 months to 10 months to actually build and complete. So I'm quite used to it, but I know some clients aren't used to it. I'm just mentioning this. I've just bought a house and land package in north of Brisbane. I signed for it last year, if I'm correct. The land is only registering the end of this year. Do I mind that nothing has happened? Absolutely zero. I've signed for a house and land package and the land hasn't even registered. I haven't settled on the land. I've only paid the little holding deposit and some other deposit, I don't know, 7 grand, 12 grand, something small. Am I worried? No, because it's not costing me anything. And by the time they start building, when the land does register, that land is already, I can tell you, as of right now, as I'm sitting here, it's probably worth $100,000 more already. Then they're going to build it. It's going to be worth even more than that. So I'm just letting you know, it's better to get in the market with the right asset in the right location than to say, oh no, I'm not prepared to wait. Give me something now, because you can find something now, but it may not be in the right area and it may not be the right asset. So we say this because we do property research. It's very important that you get into the right area. So, I could say, look, in Queensland, everything has grown in the last 5 years. Okay, no matter what you bought, it's grown. But if you look at the suburbs that we put our clients into, they have grown above average. We've got some phenomenal returns. I'll show you them at the end of this presentation. So property price growth. The national trends, I just want to say this, the national trends, we've seen that home values have gone up 39% over the past 5 years. Okay, that's pretty normal. But look at the numbers. It means that the median dwelling value is 230,000 more. So for people, that's a lot of money. That's like saying 5 years ago, if you bought a home in this area, it cost you 230,000 less. That's substantial. So affordability is a big issue. And that's another reason that demand is driven so much in Queensland, because affordability is much better there. All right, just quickly, Queensland versus other states. Well, Queensland we've seen has been less sensitive to interest rates because of the very strong interstate migration. Out of all states in Australia, the population has moved from all states into Queensland. It's got a net inflow. And as I said, way more affordable than places like Sydney or Melbourne. Very good rental yields as well. So that's another reason. This is just basic rental yields. We've actually got some display homes at the moment, and our rental yield is 8%, 8 guaranteed for 2 years. It's not a common thing, but on display homes, when we do get them, they're really quite good assets. As for other states, well, Victoria has got not a really good investor demand. They've got some very harsh legislation there for investors. The taxes are extremely high. Land tax has gone up like unbelievably high. So people are very disappointed, and a lot of people are leaving. And also we see people selling their Victoria homes as well as the New South Wales homes, taking the profit from there and moving somewhere else that's more affordable, putting $500,000 into their retirement savings, and still buying a more beautiful, bigger home than they were in either Sydney or Melbourne. As for Perth, yes, it does have strong yields. It's got good low vacancy. But the problem with Perth, and we don't put clients into Perth at the moment, even though we've got a lot of opportunity and many developers would love us to sell their Perth options, we're not doing it because it is too reliant on mining. This is quite important. There's a lot of people selling, a lot of property groups selling in Perth. I'm telling you, as your friend, as a person who wouldn't do it to myself or someone I know, I wouldn't do it to a stranger. We wouldn't recommend going into Perth because it's got one major pillar of employment. So if anything happens, like if China sneezes, Perth gets a cold. If anything happens with a war or something major in the world, it affects the resources and mining sector in Perth, and it is so heavily reliant on that sector. If that sector is down, everything is down. So we look for areas where we've got many pillars of stable employment, like agriculture, tourism, education, universities, medicine, medical, like major hospitals, all kinds of pillars of employment, even innovation, technology, things like that. So that's just an overview of all the states. So just a few forecasts, I won't take too long. Queensland's the best positioned with really good expectations for growth, as well as the Olympics that are coming. Several suburbs, can you believe it, in Brisbane are now going to hit $1 million, which is quite something. We're also looking in regional areas at the moment in Queensland, places like Townsville, places like Toowoomba, really good growth in those areas. As we said, WA, it's got some less than Brisbane, but some good growth, except was too reliant on one employment sector. As for South Australia, 7 to 9%, fueled by affordability and also population growth, but we don't put clients into South Australia because low population means it's very volatile. Boom one day, bust the next. Tiny change there shifts the property market significantly because it's got very low population, so it's just too volatile. As for Vic, no, We don't recommend anyone buys anything there. And Sydney the same. It's too expensive. It's too heated. The yields are bad. The rental yield versus the price of the property is really not good for an investor. You'll be forking money out, emptying your pocket trying to hold an investment property in those places. All right, so key takeaways. Queensland's the place with the edge, high rental yields, low vacancy, and strong price growth. The interest rate outlooks, well, we hope to see some more cuts, and if we do, that's going to boost demand even further. So it's good to always act early, because the later you wait, the higher the price will be. I'll give you an example. We got a phone call today from one of our developers on one of the projects. The price overnight has jumped 30,000. And this is for a townhouse, okay? So prices are moving literally every week. There are supply constraints. I said there's a national housing crisis, but it's exacerbated in Queensland even more. It's good for investors, not easy for people living there, but really good, solid for people investing, because you always have a tenant, you always have someone there with the demand for your property, and in the right areas, of course, very good capital growth and very good infrastructure development going on there in the locations that we're looking at. So as for our investor strategy, well, we specialize in certain suburbs where we've got very strong rental demand and affordability, above average price growth potential, and it must tick all the boxes. So we look at, it must be near a shopping center, medical, transport, access to highways, sports fields, schools, private schools, state schools, preschool, everything. So when we look at our suburbs, we just want a person to say if they were ever renting, yep, and they go there, it must tick all the boxes. 5 years later, if someone's buying it off you, yep, it must tick all the boxes. So that's what we look at. This is just in the presentation. I've only got one. I normally put like 6 or 7 in to show people, don't believe the media. Not always, but most of the time. They just write scary rubbish, okay? I can tell you, I've got so many headlines. If someone wants to see them, I'll show them to you. But if you're going to believe the media, you're going to go in the wrong direction with property most of the time. Look at this headline. It says here, shock new figures show if the current price of growth is maintained, Brisbane will overtake Sydney as the most expensive capital to buy a home in Australia. Really? Do you think that's true? Please note how they write. This word if you read articles in the media and it says if, just understand it doesn't mean it's going to happen. It's like saying if it continues. I've got some things saying there's going to be crashes. They said that COVID was going to plummet the market and drop prices by 85%. Think of that, 85% price drop. That's like saying $1 million property is going to be under 200,000 soon. That's mad. None of that happened. Prices went up during COVID. So what I'm saying to you is just be aware with the media what you read. If you're not sure, please ask us. We're happy to help you. We've got the research and we can verify things that the media says, but most of the time it's wrong. I just want to put this into the presentation tonight. If anyone here does not own any property and they're looking to buy their very first property, I just want to make you open your mind and consider something else. How about you consider building wealth without compromising where you live? So should you buy your first property to live in, or should you buy your first property as an investment? I'm not going to tell anyone what to do, but I'll tell you what I believe and what I have done. This is not financial advice. This is a disclaimer. I'm not giving anyone advice. I'm just telling you what I did. I'm still a rent investor to this day. I've been living in Australia for 15 years. I bought my first investment property 1 year after immigrating. So 1 year after arriving, I bought my first one. I still rent today. I have got now a property portfolio and I still choose to rent. And I'll tell you, this is my philosophy. So I've got you. If you're considering to buy a home to live in, you might want to rethink that decision and explore other options. Investment properties are one of the most accessible and popular ways to build wealth. So they give you tax benefits. If you earn $100,000 a year, just to make numbers easy, you're paying about $40,000 in tax. My friends, $40,000 a year. That's a lot of money. You could get tax deductions if you have an investment property, you could deduct a whole lot of money back from tax because all expenses on investment property are tax deductible. If you own your own home, zero tax deductions. The other thing is maintenance. If you own your own home, you got maintenance. I challenge anyone here who owns their own home to convince me that their home doesn't cost them a minimum of 10 to 15,000 a year in maintenance. I work with Nancy, many of you know her. Nancy's been working with me since 2018. She owned her own home for many years, and I used to ask her every year as we were working together and added up everything to maintain that home during rainy seasons and things that didn't work and fixing it. It's expensive. I rent, my aircon blew up 2 summers ago, not blew up, but it stopped working. Called the agent. Within the day, a person came, replaced the aircon, fixed everything up. I didn't pay a cent. There was a leak behind the shower, behind the tiles. Complained about it. Plumber came, that broke into the whole wall, replaced the pipe, put concrete back, retiled the whole bathroom. It looked brand new and stunning. Never cost me a cent. Okay, so I don't have any expenses. I can move if I don't like the area. If people buy their own home and they haven't lived in the suburb as a renter first, you don't know if you like the area. But if you don't like it, you're never going to move, because why? You've just spent, I don't know, 50,000, 100,000 in stamp duty. I can move every 2 years if I want. I don't pay anything in stamp duty. So this is my philosophy. I just want to share something else with you. Okay, besides having a passive income stream, it definitely does. It's a stable investment. If you buy your first property, let's say you got capacity from the bank at 700,000, you can borrow 700,000, and you went and spent that 700,000 on your own house. You cannot invest again. Your capacity is gone. It's toast. You'd have to increase your income anything between 75,000 to 150,000 to borrow another 500,000 to $1 million. That's the range. Not easy to suddenly increase your income by 70 to 150,000. But if you bought your first property as an investment, you also get an income stream because you got rent, which means you could probably buy a second one. And after a year or two, there's a bit of equity in those 2 properties. You could probably buy a third one. You can use the equity to get into the next one. You can't do this and borrow again because there's no extra income stream if you buy your own. Another thing about live where you want to live. When I met Mike, for the first 5 years, I kept asking Mike about buying my own home versus an investment. I had money to put into the market again. And every time we had the conversation, I understood if I'm going to buy my own home, I am going to move way out of the suburb I'm in. So I did a quick test today. I just looked at Breakfast Point. Just any example, any suburb is the same, okay? Just as an example. If you wanted to buy a 3-bedroom apartment in Breakfast Point and you rented it, it's about 1,250 a week. It's about 5,400 a month to rent. If you bought the very same thing, you would have to pay 10,000 in mortgage repayments at the current interest rates right now. So if you wanted to actually buy and maintain your 5,500 payments, you couldn't live in Breakfast Point. You'd have to go to suburbs like Lidcombe. Suburbs, even Lethbridge Park came up. Some very small apartments in towers in North Sydney. That's a completely different area. You far removed. So if you want to discuss this with me, I'm happy to talk about it offline. I just want people to keep their minds open, because back in the day, the history of money, the richest people in the olden days were called landlords. They never said the rich people, the aristocrats, the noble people. They never said, oh, they owner-occupiers. They said they landlords. They owned all the properties that the common people used to live in, and they were the wealthiest people. So the banks realized that interest is highly profitable for the banks. So in the early 1920s and 30s, the banks got together and said, how can we make people pay interest every single day? And all the people pay interest, not just the rich ones, but all of them. They started a campaign called the American Dream, and they started doing advertising from then already. Own your own home, and then it became the Australian dream and every other country's dream. You can do it. I'm not saying don't buy your own home. Mike Anderson, who owns 2020, he's got his own home. It's a beautiful home. But Mike started himself renting until he made enough money in his rental properties, buying and selling them, the same strategy we do with clients, until he could buy his first apartment. I think it was a 2-bedroom in Bondi. And he kept that after a couple of years. And by the way, he bought it cash. From his investment properties, made money, and he bought it cash. He took all the equity in his first property, went back into the investment market, carried on. Then he bought a house, and always using the equity to get back into the investment market. And every time he made money on investment property, then he got a loan on a house to pay that mortgage down. So to create wealth, you need to have no debt on your own home. But debt on investment properties is tax deductible. So that's called good debt. I'm just giving you a quick background there for people who might be new to this. All right. As for Queensland, I just want to show you, this is people leaving. This is 2020. Okay, it has changed, but I just want to show you that it's gone even more crazy. 30,000 into Queensland. In 2022, 53,000. In 2023, 31,000. So Queensland is the most difficult to get property now. So when there are options, they go extremely quickly. Just want to show you a couple of examples here. So we do townhouses off the plan. Everything's off the plan because you want the maximum tax deductions. If a property is not new, you only get half the depreciation because your fixtures and fittings, you cannot depreciate on a second-hand property, and it's a lot of money. So townhouses are now between 615 and about 850. We also do house and land packages. The price range is about 690 to 950. Of course, there's some more than that, but that's the average range. We also do industrial properties, the basic concrete shells. I'll show you some now, quite good for investment if you want to get into commercial. All our properties have a rental guarantee, so there's no cash flow risk. And of course, it's easy for our developers to offer these rental guarantees because there's such a shortage. So there is never really no one looking for a property to rent. Okay, this is Sunshine Coast. I was talking earlier about one bedroom and 2-bedroom townhouses. It's these, and the price starts at 615,000. I myself own one of these. They're really, really good assets. We've got stage 3 and stage 4 still coming. Stage 1 and 2 have been sold, and stage 3 I think is also just about finished. This is what they look like. There's a 2-bedroom and 1-bedroom kind of on top of each other. On the bottom and half of the top is the 2-bedroom, and the other half of the top is the 1-bedroom with the balcony. That's what they look like inside the 2-bedder. Nice open stairs. It's just different. They've got double volume ceilings upstairs, so nice airflow. The price point starts at 615 for a 1-bedder, and the rent's approximately 550 a week. Then in southeast of Brisbane, an area called Thornlands, we've got some townhouses there. Very nice. These are 3-bedroom townhouses. The price point is 840,000. The rent's approximately 700 a week. Very good also if you've got a self-managed super fund. That's a perfect asset to put in there. These are the industrial units. They look like this. From the outside, they basically, there's nothing inside, just concrete and a mezzanine floor in concrete that's quite strong. You can put heavy machinery up there, a truck, anything you want. And there are no expenses for the owner. You only pay the managing agent. The tenant usually pays all the outgoings. This is another example. This is what they look like inside. If you can see this concrete shell, that's it. Upstairs, downstairs, you can't see, that's much bigger than it looks from here. There's a small little kitchenette and a bathroom inside, but otherwise there's nothing out. The fit out is done by the tenant. These are approximately 1.2 million, and they have about a 6% yield, which means you get about 1,384 a week on a 1.2 million, 6-month rental guarantee. And the leases on these are really long. They're like 10 years, more or less. So if anyone has never diversified out of residential and they're keen, this is a very good asset because there's no costs to you. All the outgoings are picked up by the tenant. Okay, this is house in North Harbour, 900,000. 4-bedroom house. It's got 2 living areas, so nice and spacious. Rents approximately 750 right now, but obviously rents keep going up. Just to give you an example, we do have more options than this. We're also doing house and land packages in Townsville. The prices range from 700 to about 760. We're now also in Toowoomba with house and land packages, brand new market. We've got several options. We're getting more and more every day. Mike's been in the area quite a lot for the last few months. And then, as I said, we also have now and then, these are very rare, but we do have now and then display homes. Why these are nice is, first of all, they're at cost price. And secondly, they've got very fancy fixtures and fittings, but the rent is 8% guaranteed for 2 years plus a further period. So if I give you an example of one, I'll just get my calculator out. I sold one today. It's 1.195 times 0.08 divided by 52. So on a 1.195, call it 1.2 million, the rent is 1,800 a week. And it's guaranteed, and no one's living in it. It's a display home. So they use the garage as the office, and people walk through this very fancy display home, and then 2 years later, they can extend the lease if you want, or it becomes a normal residential home. So 2 years from now, the house is actually brand new. It's not brand new now, it's brand new in 2 years' time, because no one's living in it, no appliances are cooked in, no showers or bathrooms are used. So these are different options, but they are really good with yield, and obviously there's also capital growth for sure. So I'm going to show you some client performance. This, I'm going all the way back to the year, 2014. This is a house and land package in southwest of Sydney when we were in the Sydney market back then. We're not there now, but back then. There's a house for 530,000. A client had to go overseas, so waited for the year to lapse before he immigrated. He sold his house for 715,000, made 185,000 in just 13 months. Some of our clients held on to these. They've sold them recently for 900,000. So they've made about 400,000 on these if they held them. This is my own house that I had in Central Coast. I bought it for 450,000. NRES means National Residential Affordability Scheme, which means I also got $10,000 tax-free every year for 10 years. I sold the house 2022 for 790,000, made 340,000, and was positive cash flow, $200 a week. I offloaded this property according to our strategy and invested in Queensland. That's the reason I sold it in that year. Newport, put clients into house and land packages in 2018 for 623,000. 3 years later, the client sold for 852. They made 228,000 and were cash flow positive, $160 a week. Meriden Plains is Sunshine Coast. We started off with these tiny little villas for $395 in 2020. This is just a year and a half later. The price was $498. The client made $103,000 on a little 395 property in just a year and a half. This same property now is not $498. It's about $570. That's what it's worth today. Here's some most recent ones. When I said we exiting markets we were in Queensland and helping clients reinvest. This is Springfield, southwest of Brisbane. 325,000 capital growth from 2018 purchase to 2024. That's 6 years. They made 325,000. This client in Tagum, also in Brisbane, 380,000. This is a phenomenal result. They bought for 450. That's an excellent result on 450. They sold for 830 6 years later. Here's Boondall, right next door to the previous one in Tagum. $286,000 uplift. This one in Thornlands, I just showed you we're selling in Thornlands at the moment. This client made 335,000 in Thornlands. They got in the market years ago for 550. Meriden Plains is Sunshine Coast, bought for 405,000. This is the same developer as the ones I showed you in Sunshine Coast in a place called Buderim. This is their first project from 2020. 450, the client sold in 2023, made 232,000. Sippy Downs, we did apartments there, and a client bought for 433, and 2 years later they sold for 660. So in 2 years they made 226,000. Palm View, this is also in Sunshine Coast. Client bought in 2022 for 515, and literally a year and a bit later, look at the price growth, 760. They made $245,000 in just over a year. So a really good result. So that's it. This is the summary. The first thing before you think of investing is you must know why. What is your objective? Why are you doing it? What is your plan and your long-term plan overall? Is it to pay down debt on your own home? If you do have debt on your own home, that would be the best and smartest first goal, is to pay down the debt on your own home. All right. So what we do is we utilize the research, and we also understand the exit point, because we do want to manage our portfolio. We use the property proactively, just as a tool to achieve objectives. We're not attached to the property. We're not emotional about the property. We don't fall in love with the property and hold on to it. No, we just say we want to make a certain amount of money. Property is the tool. We could use any tool. Some people use shares, some people use crypto. We use property, and we use it proactively. Everything must make sense with the numbers first. If the numbers make sense, then the research must make sense. If the research makes sense, then we go look at the area, and if you like it, absolutely, that's how you make the decision. So we also actively manage our clients' portfolios. We don't charge any fees. If you want to talk to us, if you want your portfolio reviewed, we don't charge a cent. We get paid by the developer. We sell for the developer, like any estate agent gets paid by the seller. We don't advertise a dollar. You'll find we don't advertise anywhere. All our business is word of mouth or repeat business. And we get repeat business because we focus on the client's performance. If the client does well, they'll tell their friend, their family, and so on. So if you want to participate and get into the property market, as I said, the earlier you get in, the more money you make. Prices just keep going up. The days of the 300,000, 400,000 properties now in Queensland, my friends, are gone. There's nothing like that now. Everything starts with a 6, if it's in the right area, if it's the right asset. And don't just buy anything because you can afford it. Rather talk to us and work out a way that you can afford the right property. We've had people come and they can't afford it on their own, and after the discussion, they come back. It's true. 2 young guys came back and said, we'll buy together. These 2 young guys bought together. A couple of years later, they sold. They made good money each. And then they each went and did their own thing. One reinvested with us, and the other one opened himself a coffee shop. So don't just jump into the market. And also, we don't recommend buying in the inner ring around Brisbane because the yields are not very good. The prices are very, very high, and the numbers don't really work from an investor point of view. So we want the right rent level versus the house price level. When the gap between the house price and the rent is not $1 per thousand or is close to that, it's probably not a good investment. It ends up costing you money. We don't want it to do that. So if you want to participate, step 1, get your finance assessed. Get a broker, any broker. I recommend a broker rather than your bank. Why? Because a broker looks at every bank. Your bank only looks at themselves, and they try to sell you whatever they can. They'll talk the talk, but it may not be the best deal for you. So I recommend a broker. Just give them your top line numbers and say you want a top line assessment. Once you know your capacity, that's when you come and talk to us so you know where you stand. I can work it out. I'm not a broker. It's just rough numbers, but I can give you indicative. But you must get your finance assessed, your capacity assessed, so you know what you can do. Then what I recommend is we meet and we have a chat and we understand what you want to do. What is your objective? Now, steps if you'd like to get involved. I'm just letting you know this so you I'm managing your expectations and you don't get disappointed. You need to be willing to act decisively. The market is so short supplied. The chronic shortage is so chronic that properties can sell 10 times in a day in the local market to local people trying to find a place to stay. As 2020 Property helping investors only, we really have to work extremely hard to get stock for our clients who are based in Sydney or wherever they are, because that developer can sell that property in the local market straight away. It doesn't even have to pay agents commission to us, nothing. So we get the stock, but they could sell it 10 times in a day. So if you do get shown something and your capacity and numbers are right and you can afford it and you want to invest, all I'm saying to you is, if you like it, put in the expression of interest straight away. It's not a contract, it's just an expression of interest. If you go and have a look and you don't like it, you lost nothing. If you put a $1,000 or $2,000 holding deposit, you get the money back. But don't wait with the EOI, because if you wait, that property is gone. And then there's nothing to talk about. And we can't bring the very same thing back because, as I say, prices keep moving and things get sold out very quickly. So that's the first thing to mention. The next thing is, I do recommend, if you are interested in anything and you do put in an expression of interest, that you take a trip to see the property. If anyone's going to be spending, I don't know, $600,000 on a property, you may as well spend $300 on a flight in the morning, out in the afternoon, go on a tour with me, see the infrastructure, see why we're excited to invest there, and you need to leave there excited yourself that this is really going to be a great investment and you're happy and you know why it's going to work because you've seen it with your own eyes. The next thing, when you come back, your contracts will be drawn up off the expression of interest. You'll get the contract. If you did participate in this and you got the contracts, another thing I want to say is sign the contracts swiftly. Don't sit on them for a week, 2 weeks, 3 weeks and wait. Prices keep changing. We've had some clients sit on contract and the price has changed. So when the contract comes, sign it, lock it in. It's subject to finance. So if you're not sure of your finance, at least sign the contract subject to finance so you can work that out, but don't wait. The next thing, use our service providers that we recommend. You just get a better result. So we recommend certain conveyances, certain people for insurance, certain people for property managers, certain people for the handover. And if you do that, you get the best result. So better control what we control, you get a better result. Remember, we manage your portfolio. So if you've got any problems at all with your, I don't know, property manager, whatever, you tell us, we'll definitely sort it out. Our property managers are very keen to do the best job by us because we put several clients into a project, not just one. All right. Anyone have any questions? Please type them in the chat box or unmute your mic. I'll just unmute you. It'll alert me to click on that. But let me know any of these areas that you want more information on. If you do, you can send me a text. Here's my number at the bottom, 0449159928. Send me a text on any one of these four. 1, would you like to understand your borrowing capacity? 2, are you interested in purchasing potentially a property in your self-managed super fund? If you've never thought of that, it's a very wise investment. If anyone here has got more than $200,000 in their self-managed super fund, or have got an industry super fund and not a self-managed, you might want to consider. I kept my industry super fund. I've got a self-managed super fund. I just rolled over enough money into the self-managed one, put a property in there. Why? It's leverage. So if you've got 200,000 and you buy a $600,000 property, suddenly you're growing an $800,000 balance. That's called leverage. And then several years later, you've made profit on it, you sell it. In a self-managed super fund, you only pay a flat rate of 10% capital gains tax. So it's a really good saving. It's a great way to build your retirement savings. Number 3, if you'd like more information about any of our property options, send me a text and let's put time aside to chat. Even if you're not sure, even if it's a plan you want to do months from now, let's have a chat now, because you need to put it on the radar, put your intentions down early, know what you need to do. I've got some clients who said, we've got different projects. Some are actually complete, like we have some right now that are actually finished. People can buy them and they rent it straight away. We've got other projects where the land only registers, some even next year before they start to build. That suits some people. Some people have said to me, I've got this change in my life. I can only settle on the property, I don't know, let's just say February next year. Then we say, great, sign for it today, today's price, this is it. It will only settle, I don't know, April next year. And then they get what they want. At least they're in the market at today's price. Because if you come to the market next year, February, and say, well, now let me buy, you are going to pay substantially more. And I mean substantially more. the prices are literally moving week in and week out. They keep going up. So the earlier you get in, the more money you make. The market is accelerating at the moment. It's very, very tight. With a chronic shortage, it really is. But it's a great time to get in as an investor. And then number 4, if you do have any property, whether you bought from myself or from us 2020 or from anybody else, doesn't matter when you bought them. If you have any investment properties, no matter how long or how many or how old, and you want that portfolio reviewed, we're happy to do that at no charge. Just give you our feedback on it, what we think, what's the best, how to optimize it, how to be most tax effective, or even look at your structure potentially. That's it. That's it from me. So if anybody has any questions, please type in the chat box right now, or do you want me to leave the screen on? I don't know if you want any information here. Maybe I'll just leave the screen on. So you've got my number there. Otherwise, I'll stop the recording. Okay, so we've got a question, which is a person already has owned an investment property for several years. Maybe it's 3 or 4 years now. There is definitely a couple of 100,000 in equity. The question is, do they refinance and buy another one? So it depends on your income, because your income determines your borrowing capacity. If your borrowing capacity is there, absolutely you can do that. Something else I want people to understand, when a person, let's say, bought for 500 and the property is now worth 700, you don't have 200,000 in equity. The bank works it out this way. They take the current market value, let's say it was the example, you bought for 500, it's now 700, they take 700,000, they times it firstly by 80%, and the number then becomes 560. From the 560, they then subtract your loan. So if you originally bought for 500, your loan's probably 450. So you minus 450,000. And instead of saying I've got 200,000 equity, you've only got 110 usable equity. So even if you've got 200,000 equity, you can't use all of it. You can only take the value of the property today, 80% of it minus your current loan. So a broker needs to be involved to see what is your affordability. But in that very example, there's 110,000. I did that. It helped me get, it helped me expand my portfolio in Queensland. I refinanced a townhouse. What actually happened, I bought a house and land package one particular year. And about a year or two before that, I bought a townhouse. And then at some stage, I refinanced both of them and pulled out 300,000 and bought another property outright. Now, my circumstances are different to anyone else's. You can say, do I buy outright? No. It depends on the person's circumstances, because having a loan, if you're paying a lot of tax and you know, earning income, paying tax, you do want to have loans to be tax deductible. It was just the way I structured that for a particular reason. So the answer is it depends on your income, and you need to have your capacity assessed and see a broker, and then you know what your capacity is. And if you can, the answer is absolutely yes, do it.
Okay.
Yeah. So if a person has their own home and they got equity in their own home, let's say a person lives in $1 million home in Sydney and your loan is 200,000 and you're not using that $800,000 worth of equity, it's just not the most effective use of your resources, because you could be so far ahead financially 5 to 10 years from now if you use that equity to get into investment property. Now people say, oh, but I don't want to risk my own home. You're not really risking your own home. The banks tell you that you're risking your own home because you're using your equity, but the asset that you're buying is securing the loan. So there's an asset there. If you're buying a townhouse in Sunshine Coast or whatever it is, that is securing the property. So you're never really using your own home, even though at the end of the day, it is against your own home, but you've got another asset. Okay.
Okay, thank you.
Anything else?
No, I don't think so. Guys, anything else, Dad?
No, fine. Thank you, Jeanine. That was great.
Thank you. Thank you.